Welcome to today's executive briefing, the rise of client tax reporting in Asia. Tax remains a hot button issue across the world, even more so in Asia. For decades, high net worth individuals have tended to only report their onshore holdings, but not their offshore accounts. With the ever-growing number of international regulations, obliging financial institutions and regulators to share taxpayer data across borders, it's clear that this is no longer sustainable. We see in the emergence of international initiatives such as CRS and FATCA that they are more than mere reporting burdens, but clear, targeted efforts by local governments around the world to crack down on decades of tax evasion. Hello and welcome. My name is Brad Maclean and I am co-founder of Regulation Asia. Trusted by regulators and market participants alike, Regulation Asia is the go-to actual news source on financial services regulation impacting institutions in Asia. In today's briefing, the rise of the client tax reporting in Asia, we will look to explore tax transparency, reporting, regulatory friction, and enforcement relating to this incredibly sensitive topic of cross-border client tax reporting. Joining us in today's discussion is our expert partner, BearingPoint. In the business world, change is constant. BearingPoint enables companies to connect the dots, capitalize on change. Today, more than ever, BearingPoint continues to be a pioneer and is on the forefront of the new wave in consulting, augmenting the latest technology with their deep industry knowledge and practical insights. Helping us today to explore tax transparency reporting and amnesties is Ronald Frey, who is globally responsible for RegTech products. And from Singapore, Marco Kundert, Head of Tax Products for Asia. Welcome, Ronald and Marco.
Hi, everybody.
Hello, everybody.
Hi. I'd also like to welcome our final expert to the panel, Pamela Kiesselbach. Pamela is a senior member of the Herbert Freehills corporate crime and investigations team. She's worked out of the firm's Singapore and Hong Kong offices for the past 6 years, advising global and regional organizations on corporate crime, investigations and related issues with a particular focus on large, complex cross-border investigations, be it internal, regulatory or disputes. With Pamela's assistance, we look forward to delving into the hot button topics of enforcement, as well as the outlooks in identifying, ring fencing, and remedying risks to clients. Welcome, Pamela.
Thanks, Brad.
To help kick off the discussions, Pamela, I was hoping if you could just walk us through why tax transparency is so important, and what are the drivers behind initiatives such as FATCA and CRS?
Yeah, Brad, thanks for that question. Now, just to sort of kick off, as probably very many of those who are listening in are aware, many jurisdictions tax their citizens and residents on a worldwide income basis. So taxpayers are legally required to report their worldwide income, both onshore and offshore, to home tax authorities. But there is historically been widespread non-compliance, both intentionally and non-intentionally, and also through use of sophisticated tax evasion schemes, which are often focused on jurisdictions with strict bank secrecy laws. And that has probably become sort of into stark focus in the context of the Panama Papers and the Paradise Papers fairly recently. So CRS and FATCA are two tools in a fairly wide-ranging toolbox, which provides for automated exchange of information regarding bank accounts and certain other investments that are held abroad. So it provides information about assets held offshore to enable tax authorities to start chasing their citizens and residents for the payment of their tax.
Fantastic. So with this in mind, for me, the top key issues that we're looking to explore today are tax transparency and the reporting across CRS, FATCA, and tax amnesties, regulatory friction and enforcement trends, and finally, how to best leverage technology to ring fence risks. But above all, I'm keen to hear from our panelists on the push towards harsher penalties. These go far beyond fines, potentially threatening to see withdrawal of banking licenses. I'm keen to understand what bankers need to do to better support their clients' cross-jurisdictional tax reporting needs. However, before we set sail on this journey, I really wanted to set the scenes. I really wanted to understand, where is the world's offshore wealth? It's estimated that an equivalent of 10% of the world's GDP is held in offshore. At this point, in time, there's few offshore centres actually disclosing data on the amount of the global wealth actually held. However, on the limited data available, this is what we know. Now, these are a couple of statistics here from the BIS, the Bank of International Settlements, and BCG. Now, it's important to keep in mind that these estimates are conservative and that it excludes important offshore centres such as Panama and Singapore. And it's also limited to data based on bank deposits, not the portfolios of equities, bonds, mutual funds, or even real estate in which most offshore wealth is held. So the difference between the BIS and the BCG estimates are BCG estimates that the equivalent of 14 to 15% of the world's GDP is actually held offshore in these wealth centres. Now, if we look on the right-hand side, we see currently where the wealth is being held, but the big question is, where is the world's offshore wealth growing fastest? At this point in time, Switzerland remains the largest offshore wealth centre with a share of 24%. Switzerland, having been a pioneer of the cross-border wealth management as early as the 1920s, however, more closer to home in Asia, in Hong Kong and Singapore, we now see the fastest growing offshore wealth centres due to their status as the preferred booking centres for regional clients. According to recent research, Asia Pacific is indeed the fastest growing source of offshore wealth with a compound annual rate of 6%. But we're seeing a new era of transparency. The impetus for both CRS and FATCA stem from a similar idea, a standard for exchanging financial and tax information on a global level. Let's consider the trends in Europe. When considering Europe, we need to remember that Europe was especially hit hard by the Panama Papers. And as part of this fallout, we see a focus in Europe going well beyond meeting domestic and international requirements on tax reporting, but a push to transparency to avoid reputational damage. In fact, when we look at reputational damage in key markets such as Germany, authorities have publicly exposed tax evaders, identifying them publicly in newspapers. Though fines for non-compliance are not particularly high, with such threats of reputational damage, many people decide to proactively reveal their assets. So too, Europe is looking to put pressure on advisors with new measures targeting accountants, lawyers, tax advisors, and banks to report aggressive tax avoidance schemes by 2022. So, Ronnie, I guess the big question I'd like to ask you, with your experience in Europe, is should we be looking to Europe as a lesson for Asia on how we'll face greater tax scrutiny here in Asia?
Yeah, thanks, Brad, for the question. I think very much so. I mean, what we have seen in Europe over the last 5 years now, as soon as FATCA came into play, not so many banks were too much concerned because, the number of US clients was not so widespread in the organizations. But when the OECD made clear that it would further crack down on the global tax evasion and introduced the CRS, it has become a widespread topic. So ever since the introduction of CRS, we have now seen, across Europe, and also it's true across, for instance, South America, lots of countries who have, included on their agenda so-called either voluntary disclosure programs or offer tax amnesties, either to incentivize those offshore wealth to come back to the country itself, or at least to make it transparent to them, so where the offshore is held. So there is a tremendous push on tax transparency of what we see here in Europe. Sometimes, as you just mentioned, even enforced by the government by exposing expressively people that have so far had money undeclared. So what we have seen is this growing trend for tax transparency. And when you look at it from a client perspective, so from an investor that has assets offshore, it means that there is now clearly the pressure on these clients, to declare the tax in the tax resident home countries. And that is why a lot of these clients more and more have turned to the banks and to ask this as a service, so that the bank is enabling them to better to be in a better position to file the tax at home. So there was a growing demand from banks to get tax reports.
Excellent. It sounds like there's definitely been an evolution over the past 5 years in terms of the demand you're seeing around client tax reporting. Now let's just flip over and consider the trends in Asia. Well, in Europe, the focus is on reputation, the forced adoption, The focus in Asia we see is to be more on connectivity in the region and educating clients on the importance of client reporting. In Asia, we have seen more than 12 local regulators sign up for the automatic exchange of information under CRS to combat cross-border tax evasion by facilitating sharing between jurisdictions. We see that from the more than 50 automatic exchange of information relationships, Singapore has already agreed to share information with a total of 10 major markets, and Hong Kong has already got agreements with 70 jurisdictions in place. So I guess, Pamela, given the focus on cross-border collaboration, are banks being targeted by foreign governments to obtain information on accounts held by potential tax evaders? And what are the tools being used by different governments to obtain this information?
I think, Brad, it's quite interesting, and in this respect, as in sort of also in the corruption area, actually the US is probably the most aggressive enforcer to date, and Swiss colleagues on the panel will probably know a lot about the Swiss bank program. So the US is the one that's been using the whole suite of toolbox. And that will include sort of voluntary disclosure programs, so requiring taxpayers to come forward and to voluntarily disclose their assets under sort of an amnesty scheme, as well as basically filing mutual legal assistance sort of orders under mutual legal assistance treaties and asking for information cross-border from other tax authorities. And they've also been very aggressive in simply serving court summonses on banks and asking them for information held in relation to their customers. So they've used quite a bit. Now, as far as other jurisdictions are concerned, they have been, I think, less active on the tax enforcement cross-border. So they will have gone after the customers, the tax evaders, and Indonesia is, for example, a recent example where they've run a tax amnesty, which they've declared as being very successful, and again asking the individuals to come forward and to voluntarily disclose offshore assets, and therefore either get a slightly lesser penalty or avoid a penalty. So I think voluntary disclosure programs are definitely still the most popular, although not all jurisdictions are applying them. As far as I know, Hong Kong and China has not gone down that route. The other way of enforcing, really, and obtaining information on offshore tax is through the anti-money laundering regime, because banks which hold criminal proceeds, and that does fall, and criminal proceeds do include proceeds that are subject to tax evasion, or funds subject to tax evasion, foreign tax evasion, are reportable. So banks need to, financial institutions need to report to the police or to the financial investigation units of the relevant countries if they are aware of proceeds that are subject to tax evasion.
So, I mean, you've mentioned a number of different approaches. How effective have these been so far?
Again, I don't want to labor it, but I think the US has been very effective, and I don't know how much, we don't want to probably go into too much about the Swiss bank program, but that has been an incredibly effective scheme where the US went after, just picked, and you said earlier that Switzerland is still the country which holds the most offshore assets. So they picked Switzerland. They picked UBS as being the bank that held most assets under management. And they went after the banks and basically said, listen, you have been facilitating the evasion of U.S. taxes. That's a criminal offense under U.S. laws. They have not been shy in applying their criminal laws in a very extraterritorial manner, and gave the banks a very short period in which to come forward and to voluntarily disclose information about customers, U.S. accounts, under non-prosecution agreements. And they have collected a huge amount of information under the Swiss bank program. A lot of the money has been moved, and this is, if you do get high net worth individuals who are bent upon evading tax. They will try to move their funds into the next offshore jurisdiction that has strong secrecy laws. And we have seen quite a bit of money flow going into Singapore and Hong Kong. The only problem is the DOJ has the information from the Swiss banks as to where this money went. So that has been very, very successful, and they are chasing the money around the world. I think another area where where we're starting to see more enforcement is under the money laundering rules. And again, you may be familiar in Singapore under the 1MDB debacle that a number of banks have lost their bank licenses for basically harboring criminal proceeds and not properly doing their due diligence. I can see similar steps being taken against financial institutions who are basically harboring proceeds or money that are subject to foreign tax evasion. So the money laundering rules are going to be a very, very sharp tool.
Interesting. I mean, before I previously mentioned kind of the focus on cross-border collaboration, but I also, Pamela, I also wanted to get your perspective on, have you seen tensions between foreign government information requests and local government, local secrecy and privacy laws?
Absolutely, and again, because I have to mention the U.S. because they're the ones who've been the most aggressive. So the way they go about it is they will serve a court summons on the U.S. branch of the bank and say we want to see information that is held in Singapore or in Hong Kong. And then the Singapore branch will say, well, sorry, we can't actually provide that information because that would be in breach of the banking secrecy laws. And this is what the governments who are going against the tax evaders are trying to break through bank secrecy laws. And the funds will be attracted by jurisdictions that have strong secrecy laws, because those are obviously, that's where the tax evaders are trying to hide, behind the secrecy laws. So there you get a friction between the enforcement agencies that are trying to enforce their laws abroad and the secrecy laws abroad. And we saw a particular court summons against a multinational bank with a branch in Singapore, where it was resolved in a settlement eventually on the basis that the bank did find customer consent to provide that information, possibly in the small print. But the MAS made it very clear that the bank secrecy held and that it applied and that banks had to comply with the bank secrecy, whereas the DOJ said, we don't care about foreign bank secrecy laws. Our interest in pursuing U.S. tax evaders trumps any local bank secrecy laws. So there you have a clash. And CRS is obviously a way of trying to resolve that, but it's only a limited amount of information you're getting through CRS.
It's an interesting challenge that I guess everyone's facing. I mean, Marco, you're on the ground in Singapore. Given your experience in Asia, are you seeing any other trends or effects of CRS has on banks and clients in the region?
Yeah, thanks, Fred. And to your point earlier on, Pamela, I think it is, if you look at what happens in Singapore at the moment with Indonesian clients, it is very, very similar to what we have seen, for example, with Italian clients or German clients in Switzerland. There was a huge pressure to the clients and the banks towards transparency. And this is why we think that the clients with this pressure will turn to banks and ask for more information because they need to have much more transparency, because they need to file their individual tax filings, for example, in Indonesia. So what we're seeing is, we believe, the start of a very similar development we have seen in Europe, and it starts with the Indonesian market in Asia. And if we go a little bit further, what has happened then is that a lot of high net worth individuals or ultra high net worth individuals went to the banks and asked for more sophisticated reporting. And by now we have 80–90% take-up rate of reportings which look into information related to their taxable base, etc., etc.
So, Brad, let me just add here a point. What I wanted to share here is what we have seen already in Singapore and to a certain extent in Hong Kong is where, the larger private banks, those that are really global, especially for the European clients, have actually started to provide those European clients already client tax reports, because those clients often were also clients in the same bank's European subsidiary. So they got that service already. So that is why to at least some banks in Singapore, we have already seen starting producing tax reports, mainly for European clients. And I think it will now swiftly switch over to also adding Indonesian and Australian clients, for instance.
Okay,
sorry,
that's fine. It's that natural rollout from the HQ in Europe based on their demands across their local business. But I mean, you mentioned one thing there that I just wanted to just quickly clarify. I mean, client tax reporting, what is that exactly? I mean, and how does this differ from regulatory reporting?
Yeah, so actually, I think that's a good slide to explain once more to the audience what is really the difference between when we talk about FATCA or CRS reporting and the client tax reporting. Here you can see on this example, we have an Indonesian client that has assets with the bank in Singapore. So it's a typical offshore situation for the bank in Singapore. Now on the CRS, this bank is about to report information about the client and his assets and his income to the Singapore tax authority. And in turn, later in the year, the Singapore tax authority will pass on this information to the Indonesian tax authorities. So that's let's say that's the regulatory part of it that every bank needs to comply with. Now, on the other hand, this Indonesian client has become transparent to the tax authority. So he needs to declare information for his tax filing for his offshore assets. And this client is now turning to the bank in Singapore and is asking for specific information on his assets, on his income, on the capital gains, and so on, to get information that enables him to better file for the taxation at home. And this is what we mean by client tax reporting. It's basically the report or the information that is provided by the bank in Singapore to this Indonesian client with country, so say Indonesian specific tax ruling information that will enable the client to file his tax. So that's the difference between client tax reporting and the regulatory part. The regulatory part is a compliance. You must do it. It's on standardized rules, whereas the report for the client is really a service that is based on specific rules for the given country that your client is based in. So it can be, a US, a UK, a French, an Italian client, whatever. And these are then the country-specific tax rules, which very much differ, of course, from the rules that you have to apply in your CRS reporting. So
okay,
I hope. Yeah.
Sorry. I was going to say, Ronald, correct me if I'm wrong. I'm a little confused here. Client tax reporting, that sounds a lot like tax advisory, but at least from my experience, isn't this something that banks want to stay away from?
Well, in principle, yes. So what I'm talking here about was not advisory, it was just information. You need to understand that the bank has a lot of the information in their systems that will automatically be of use for the client for the tax filing. So it's just giving him information on the facts, on assets or transactions that the client has with the bank or transactions that he had during the year. So it's information. It's actually not advisory. Now, the state of play in Europe is such that this service has become almost a must, kind of a commodity. So the major private banks, the larger one, offer this already for more than 5 years. Now we see even smaller banks have to adopt it, because when they want to pitch for business from the larger ones, you know, they have to offer, because the clients on these larger get this service. So more and more it has become a commodity, and banks are now starting to even look further and to go into this topic of advisory, but always within the legal confines.
And Ronnie, maybe to add to that, I think it is what we're seeing when we start to talk about giving tax-related information. A lot of banks in the APAC region are very hesitant because of this question and a lot of bad experiences talking about tax matters with clients. But I think this is very important to see that this is not about advisory. It's about giving the client information about his taxable base, and this is very different to advisory services.
So, Marco, I understand from a client perspective why this is valuable, but I mean, why is this also important for banks?
Yeah, correct. What we see is that if you have European clients who bank in Switzerland, but also bank in Singapore, for example, they, as Ronnie said, they expect it as something which is just state of the art. So banks need to improve on their reporting in that regard. On the other side, at the moment, you would see that it can be a differentiator for banks in Singapore and Hong Kong, especially, because it's simply a service the client will need in the future. So you can differentiate if you're a fast mover here.
Okay, so I think I'm very clear on the difference between regulatory reporting and client tax reporting. I mean, Pamela, I just wanted to ask you, have you seen any difficulties around this, kind of these issues, such as, is it possible to be FATCA and CRS compliant, but it's still exposed to the risks of enforcement from foreign authorities?
Yes, Brad, that's a good question. It's something that definitely we've dealt with quite a bit with our clients here in Hong Kong and Singapore. Quite a few of the financial institutions believe that if they are FATCA compliant, and FATCA came into force, I think from memory, about 2012. So that, maybe in 14. But when they looked at their accounts and identified ones that they thought were maybe a bit dodgy under sort of U.S. tax evasion, and they off-boarded those accounts. So under FATCA, they basically cleaned up their accounts. So a lot of financial institutions have the impression that that's fine. They're not exposed to any enforcement. However, the U.S., the way the U.S. sees the world, they say, well, no, that's not true. You are historically still exposed. So if you, after 2008 or 2009, when we put the world on notice that it was not okay to facilitate tax evasion of U.S. account holders, and you facilitated that tax evasion, even if you're off-boarded the account in 2012, 2014, you are still liable for what you did before then. And also, how did you off-board it? Did you just basically pay out the money in cash or in gold bars? And this has happened to, again, enable those off-boarded accounts to move their money around quite easily into the next sort of haven. That is, again, attracts liability. So there is definitely historic liability that that banks are facing, and as the U.S. is chasing the money from Switzerland to Asia, they have started, and we've been involved in matters where they are going against banks, where the accounts have been off-boarded. They were all off-boarded in 2012, but they're still liable. And also, an interesting thing is that the test under FATCA as to what is a U.S.-related account is slightly different from the test that the DOJ applies. So that also can catch out financial institutions. They think that they're compliant under FATCA, but some accounts that do not fall under FATCA will be considered as U.S.-related accounts as far as the criminal proceedings are concerned that the DOJ start. So there's definitely historic exposure, and if you comply with FATCA and CRS, even going forward, does not necessarily mean that you are not likely to facilitate or tax evasion, because there may be other red flags that don't really touch on or trigger a reporting under CRS and FATCA, but may be a basis for criminal enforcement, red flags that there's something fishy going on and there's some tax evasion going on.
So it nearly sounds like it's a no-win situation. With you're compliant moving forward, you still might have historical problems. I mean, Ronald, what's your perspective on the potential difficulties with client tax reporting?
Well, you know, what we have seen here in Europe is often the question, you know, what happens if the figures are wrong that the bank is giving to the client, you know, the question of liability. Now here the banks have taken a clear stance. They are providing information in the form of a country-specific tax report, but that comes with a clear disclaimer that at the end of the day, it is the client's responsibility to complete a correct tax filing. That's also true because, you know, most of the high net worth individuals have accounts or assets spread across many banks, and the client must anyway aggregate the positions. Now, from a bank's perspective, what we have seen here in Europe is there has been a lot of banks initially who try to do this somehow in a semi-manual way. So they took the data from their core banking system and just enhanced it with further information. So internal process, sometimes they involve the Big Four tax advisor to enrich, you know, the bank internal data and then to give somehow a kind of manual report. And so that has a lot of, you know, potential for having, you know, for having wrong data or missing data. So that is why, at least here in Europe, most of the banks have now gone to a solution where they use a bespoke report solution, where that is, you know, fed from the banking system with an automated interface, a standardized interface that is already doing the data validation, the checks, if the data is accurate, is it complete, does it make sense, before it actually then goes into the engine itself to do all the necessary tax calculations. And often these vendor solutions, of course, come then also tested. So for instance, BearingPoint, we ourselves test our different country-specific reports, always with a Big Four tax advisor, so that the output is really in accordance with the tax law. But to automate the client tax reporting, that's really, you know, has become the standard. And most of the banks here in Europe do not have the idea anymore to do this kind of manual. So it's really a fully automated process that either the bank is doing itself or they have outsourced the topic.
Okay, I mean, so far we've talked about the international standards, CRS, FATCA. I mean, when we look at tax transparency regimes, and more specifically to Asia, I mean, Pamela, are we seeing there are differences between jurisdictions in Asia?
Brad, a good question. I mean, in Asia, obviously, CRS is a big topic and it's being rolled out. CRS is implemented through IGAs or intergovernmental agreements, and there may be differences in those intergovernmental agreements as to the type of due diligence that banks have to conduct in order to identify whether an account is being held by a foreign tax resident. So as far as the stringency of the due diligence is concerned, we'll probably be seeing differences between the various countries. Then also, as far as enforcement is concerned, I mean, there are countries that are jurisdictions that are far more mature than others, and it probably doesn't come as a surprise that Singapore and Hong Kong, being big financial centers in Asia, are very mature as far as KYC and due diligence checks are concerned as to what banks need to do or financial institutions need to do in order to identify you know, either criminal proceeds or, you know, information to be provided through CRS, whereas other jurisdictions such as, I don't want to be unfair to certain ones, but Laos or Vietnam or Cambodia are going to be less mature. And the enforcement environment is quite, China is really stepping up, India is stepping up, Indonesia was already mentioned by, I think, Ronald, has stepped up, whereas in other jurisdictions, we're not really seeing quite as much enforcement yet.
Yeah, and maybe, Pamela, to add to that, what I find interesting as well is, as well as CRS, obviously everybody has to move and is moving at the same pace, more or less. If you talk about the tax amnesties, you see a very diverse picture at the moment, and also the trigger for the client tax reporting needs is different. We have the amnesty in Indonesia, but for example in Australia, we always had a very mature market in terms of dealing with taxes and also complex tax regimes, which leads to clients being used to getting the information. And then we'll see Philippines coming up with an amnesty. So the picture on the tax reporting side, I think at the moment, is diverse because countries moving at different speeds.
Is there going to be Ronnie, Marco, you guys will know this best. Is there going to be a difference between onshore and offshore requirements?
So, I assume that, everybody on the call, knows the difference between off and onshore on banking, but, the picture here depicts the difference, and it's really where is your client and where is the bank, right? If both is in the same country, we talk about the onshore situation. That's shown on the right-hand side, and on the left-hand side is the typical offshore situation where, for instance, an Australian client has the assets booked with a bank in Singapore. So from a bank's perspective, there are differences. When you look at the offshore situation, in the offshore situation, the bank is not, taxing transactions at source. And, you can really talk about a service at the end of the tax year that the bank is giving information to the client so he can file in his home country, the tax return. So it's kind of a service. Now, the same bank, if the same bank has an onshore client, and actually it can be the same, so the same client can be off and onshore booked, then it differs from jurisdictions to jurisdictions. There are some jurisdictions where transactions will involve the bank to already tax at source, so to levy tax on certain transactions and then to pay them to the tax authorities. So you have so-called, withholding taxation. That is a difference to the concept of offshore. And the other difference is that, but also depending on the jurisdiction again, that the bank needs to provide directly to the tax authorities certain reports, even signed reports, for instance, to show to the tax authorities what has already been levied on the transactions, so that there is no, risk of double taxation when the client files his own paper. So there are differences from the process point of view. Now, the actual rules, how you calculate income taxation or how you calculate capital gains, that is most often no different. You have certain assets sometime in an onshore situation that are tax-free because they may be, pension fund related. And the same assets for an offshore client would be taxable. So, but the rules that you would apply to determine the client's taxable base based upon his portfolio, they're actually the same.
And I think to add to that, definitely, maybe one more thing to add to that, Brad, is is if you have a global financial institution with a client, or let's say UK client banking in two different centers, like if you take Switzerland and Singapore, the Singapore hub as well as the Swiss hub needs to be able and capable to provide similar reports because the same tax rules apply to the UK client. So that's definitely a challenge for the banks to do that.
Understood. I mean, one of the key concerns I have is the fragmentation of networks and frameworks across the region. So, I mean, Ronnie, how can client tax reporting be sufficient and scalable given this fragmentation in the region? And from your perspective, what really goes into these reports? What are the key ingredients, and what does a bank need to deliver for a client tax reporting?
Yeah, so, you know, a lot of the information that is required that you need for these tax reports is actually available in the bank's core systems. And it's a mixture of having some asset-related static information that is available in your securities systems. And then, of course, the transaction data. So all the transactions that the client is processing during the year, you need to store the relevant information. Obviously, things like purchase prices, so you need to store that and you need to apply it because that will enable you to calculate capital gains, for instance. You need foreign exchange data, so a lot of, and client static data. So that's within the banks, you know, that is available. Now, for if you really want to do a proper country-specific tax report, you will also rely on external data providers. So there are, you know, data providers, Bloomberg, SIX, Reuters, and so on, that provide also, again, asset-based specific information that enables you to determine that certain assets might be taxable and certain others not. And the same is true for corporate action data. So when we look at corporate dividends, you know, some dividends, depending on the corporate, the country, are so-called qualified dividends that will be tax-free or will be taxed at a lower rate. So this is additional information that you may not have in your own system. So that's where you need to have access to external data. Now, in the end, what you need is, of course, the tax knowledge, and be able to apply all these tax rules. So there's two ways. Either you work yourself with a Big Four tax advisor who is then using the information that you give him in order, you know, to do a report manually, or you have your internal tax people to do that manually. But that's really not a scalable model. So that is why, you know, banks are have, of course, you know, used bespoke vendor solutions. So, you know, like BearingPoint's Easy Tax solution, that works on a standard interface. So there is a standard interface data description, what needs to be fed into the tool. And then the data is delivered. The tool is actually checking the completeness and accuracy of the data. And then everything is taken care of within the solution itself. So all the tax rules for the various countries where you want to apply a tax report is stored in the software. And what comes out is a tax report, which is more or less looks the same as the original tax form that the client has to use in his home country. So this is then a way to really automate the process and to get scalability. And then, you know, the final question regarding operating model is, there are banks who say we can do this internally, and there are other banks, they say I want to outsource this. So this is sort of what we see, at least here in Europe. There is a certain trend to outsource that, but then it's again a question of whether you want to give away the client-specific information to an outside company, but actually some banks are doing it, and then the outsourcing provider, you know, provides you with a report, or as I said, you do it really in-house, and then you have the solution hosted yourself and also run by your people, and that's what we see is mostly the case.
Excellent. So a couple of final thoughts before we go to the audience for questions. It's clear that tax will continue to be a hot button issue, not only just across Asia, but across the world. Aside from being a reporting burden for financial institutions, it's clear that CRS, FATCA, and local governments will continue to crack down on tax evasion. We're seeing that increasingly that high net worth individuals will need to meet additional tax reporting obligations across the region. In Asia, we've seen a focus on increased transparency through collaboration, data sharing, and education, while in Europe, reputation and pressure on advisors are the most recent driving forces behind compliance. My last question to the group, given today's discussion, is I really would like to hear what you're predicting for Asia over the next 3 to 5 years. I mean, Pamela, any thoughts on where banks and regulators will be looking over the next 3 to 5 years?
Yes, and Brad, I think one area is definitely the money laundering rules, which are very relevant to foreign tax evasion, because the breach of foreign tax laws is a predicate offense, which means that any proceeds held that are tainted by tax evasion will fall within the money laundering. This is an area which is in stark focus, partly because FATF, the Financial Action Task Force, is coming to, they've inspected or done a report on Singapore, and there was some criticism around Singapore. They're looking at Hong Kong next. And both Singapore and Hong Kong have really pulled up their regulatory requirements around reporting, and that will also capture tax evasion and any proceeds that are subject to tax evasion. So I think money laundering and tax evasion will be going hand in hand, and we will be seeing an increased enforcement there and an increasing requirement for financial institutions to hone their due diligence in order to be able to capture the red flags of tax evasion. Another thing is that we're probably going to be seeing is CRS is just virtually in its infancy. It's the information is starting to come through. Is how will regulators, how will the inland revenues authorities across Asia use that information? Because obviously the whole purpose of this information is then to be able to pursue the nationals or the tax residents who have been evading tax. So we'll be seeing how that is actually going to start being used in order to enforce tax laws. And then I think sort of just one final thing is the US has been very active in enforcing their US tax laws cross-border. The UK has just at the end of last year introduced 2 new corporate criminal offenses of failing to prevent the facilitation of tax evasion. That applies to financial institutions which have a UK nexus, or any financial institutions which assist in evading UK taxes. And so again, that is another very sharp tool that enables the SFOs, so the UK enforcement agencies, to start going around the world and enforcing against financial institutions who are assisting in evading UK taxes or even foreign taxes if they've got a UK nexus. So I think we're going to be seeing more enforcement. We're going to be seeing heightened requirements around due diligence and KYC checks, and tax evasion is definitely on the radar of very many governments who are trying to just get more of their tax revenue in.
Excellent. I mean, Marco, Ronald, any thoughts on the development of client tax reporting over the next 3 to 5 years? Will it be an evolution or a revolution?
Revolution. Definitely a revolution. I think I completely agree with Pamela. So we will definitely see increased pressure to the different markets. They will move at different speeds. And for the banks, it's important to manage that, be able to respond to the client demands, which will turn to banks for the information they need for their tax filings. And also, I think for for the banks, it can then be an opportunity to serve the client better and even build growth cases. For example, to start talking to the banks, to the clients, what is the performance, investment performance of the tax?
Yeah, I think that's a good point. Maybe for me, a concluding remark where this could go next. I mean, especially in Europe, where, as we have said, the tax reporting, the information part is already kind of commodity, which is really the key word after tax performance. You know, now that these clients are tax transparent, so paying tax on the wells they have, be it on or offshore. So they are interested in the performance portfolio, in the portfolio performance of the tax. So the next question is, well, if a bank has an engine that is able to report information for tax, you could use the same engine for doing pre-trade tax simulation. Now, there are certain jurisdictions, for instance, where it is possible to offset your capital losses when you are trading transactions. You accumulate maybe losses during the year, that you can use these losses to offset gains in the same tax year, and that's it. The losses you cannot take over into the next tax year, and that is why in certain jurisdictions the clients often deal transactions just before the tax year end, in order when they have these gains to offset the gains with the losses. So, I mean, you can say that's legally possible tax optimization. So, here in Europe, what we see is clients, the sophisticated clients more and more ask now the relationship manager, to take a view on the tax impact before actually the trade is done, right? So the whole topic of tax simulation, and if you want, moves into an advisory, but it's not to evade, to offer any structure to evade, but to optimize the tax position that is possible within the tax legal confines. So, and eventually, some of the banks here in Europe that have started to introduce this will certainly spread that out to their Asian-based hubs. And thus, it's a question of time where this will also be a topic for the banks in Hong Kong and Singapore.
Excellent. So when it comes down to the question of evolution or revolution, it sounds like it'll be a revolution, but on different timescales in different markets. With that in mind, I'd like to open up the floor to the audience for any questions. What I'd like to remind everyone is on the right-hand corner, you actually have a chat window. If you could just place your questions there. We already have a couple of questions here that I'll just quickly go through and would like to put out to our expert panel today. I think the first question is for you, Pamela. What is the timeline for compliance, and what is the cost of non-compliance?
Well, I mean, the timelines under the CRS are fairly strict as far as sort of memory serves me right. It's already started. But if financial institutions do not comply under CRS, there will be penalties. There will be penalties and regulatory consequences that will be enforced by the local regulators. Under FATCA, you've got a similar situation where the U.S. basically says where foreign financial institutions do not comply, there's a 30% withholding on certain funds that come from U.S. sources. And insofar as there are intergovernmental agreements that implement FATCA, there will also be local consequences. So they are quite hefty. There's penalties, there's regulatory consequences, and obviously reputationally as well, financial institutions want to be seen to be compliant.
And maybe I can add to that as well. I think you're asking for the cost of non-compliance. I mean, the cost of the client tax reporting topic is not a regulatory topic per se. It is something which the client demand will be driven by CRS, FATCA, and the amnesties. And for the banks, then the client tax reporting topic is more of a service topic. So the clients will turn to banks with the needs for those information. So it is definitely something which should be regarded as an additional service, and then can emerge in things like performance after tax on the investment side.
Okay, I have our second question here. So which client groups will be affected? Which jurisdictions? I mean, Ronnie?
Yeah, I think as I have said before, and what we have already seen with some banks in Singapore, definitely European clients, right? So, you know, European clients that bank with their banks in Europe, if they have started or moved their portfolio to within the same bank to Singapore, so those clients, you know, at least we know from some banks already for already 1, 2, 3 years get these reports. In terms of Asian clients, it's a question how you want to address it. Yeah, if you want to be reactive, then you just wait, right? You have to wait now for individual governments to crack down on tax evasion through tax amnesties, voluntary disclosure programs, like in Indonesia, but also in Australia. So you can wait until the Philippines are doing something. You can wait until the Chinese government makes it part of their, you know, agenda to crack down, or you can also take a more proactive stance, and you already look at your portfolio of clients, and then you see, okay, you have maybe, you know, your major clients are in 3 countries, and even so, if they do not offer yet tax amnesties as a service, and you know, to be honest, in some banks in Europe, we have seen that made it, or even internally, a policy for the bank itself to make all necessary, what is possible, that their clients are in a better position to report tax at home. So even when there is not so much pressure as Pamela described, like coming from the US or the UK, still it's the policy of the bank to also combat tax evasion and to equip your clients with a tax report that, you know, enables them to better file tax. This is, by the way, something Luxembourg introduced back in around 2009, where the Luxembourg Banking Association, basically, they could not enforce the bank to do this, but they really made it clear that it's part of the government policy and so on to give tax reports to the clients, you know, around the neighboring countries from Luxembourg. So, and banks really took then a proactive stance and did not wait, you know, until it becomes clear, you know, which country is really cracking how heavily down on these tax evaders, but really as a proactive stance. And then, you know, you could even say, okay, for me, the Philippine clients are very important, so I already start giving them, you know, information on their taxable base already now, right?
And definitely for Indonesian clients, banks have seen this in the first quarter of this year, that clients want to have this information, Indonesian clients. So it is a topic for the Indonesian market, definitely, or it was a topic beginning of this year.
Excellent, and thank you. I mean, we have a couple of other questions here, but unfortunately we've run out of time today. So I would love to thank our expert panel. We have Ronald Frey, Marco Kundert, and Pamela Kiesselbach. Thank you to everyone for joining our executive briefing today, the rise of client tax fraud reporting in Asia. Thank you very much, and have a great day. Bye-bye now.